Hello and welcome to the Global Forecast from the Economist Intelligence Unit. I'm Tony McMahon and I'm joined by Robert Ward. Well, there's plenty to worry about around the world at the moment. We've got the US deficit wrangles, Eurozone woes and the threat of inflation in China. But first of all, Robert, let's turn to the US. You're pushing your prediction of the first interest rate in the US into 2013. Previously, you were predicting for late 2012. So why have you changed your mind?
Well, this is a very weak recovery. You could arguably say this is a recovery unlike any other that we've seen perhaps this century even. One of the really things that concerns us is the weakness of private sector demand, particularly the consumers. You only have to look at the jobs market and to see how weak it is to understand why consumers are reluctant to spend and why this is sort of, I suppose, holding down the US economy. One good indicator to look at, of course, is non-farm payrolls, so the amount of jobs created each month. In May, it was about 25,000. In June, it's about 18,000. Well, we're looking for about 200,000 every month for the next few years if we're really going to see a sustained recovery that would take the US back to what it was before the crisis, which we don't actually think is likely either, by the way. Importantly, inflationary pressures look like they're under control. If our forecast for oil prices I suppose tracking around $80 to $90 to $100 a barrel is right. This will help to tame inflationary pressures, and this all gives the Fed leeway, of course, to push the interest rate increases out to 2013. One important point is, however, we don't expect any more quantitative easing, so no QE3. I think it makes the idea of printing money makes Ben Bernanke queasy. I don't think he enjoys doing it. The impact of QE as well is uncertain. It's certainly pushed up commodity prices, certainly pushed up, caused difficulties for other countries around the world with their currencies rising in the emerging markets. However, if, of course, the US economy looks like it's going to slow sharply, or deflationary pressures look like they're coming back, then Ben Bernanke and the Fed may have to revisit that.
And against the backdrop of all this congressional wrangling around the deficit, how do you see the dollar trading in the near future?
Well, the deficit wrangles are extraordinary, and certainly on the surface the US looks like it's sort of gliding towards voluntary default. We don't expect that to happen. We expect some kind of deal to be cut. The markets, in terms of the bond market, for example, are quite sanguine about what's going on in the US government, with the 10-year treasuries, for example, trending around 3%, which is pretty low. So they're kind of, I suppose, also assuming that there is some kind of recovery, some kind of deal struck here. The dollar's been a bit more volatile, however, and this could reflect foreign buyers of treasuries who are buying treasuries and then getting out of dollars in order to hedge their position. So that could be one of the sort of reasons that the dollar's been weaker over the past few weeks. If you're looking at how currencies are going to trend going forward, well, this is still the parade of the ugly sisters. They're all horrible. The yen, sterling, the dollar, and the euro, you can make a bear case for each one of them. We focused on a number of things to make our forecast, one of which is interest rate differentials. Of course, the Eurozone, the ECB is now raising rates, and this is helping to support the euro. The German economy is also outperforming that of the US, which again is helping to support the euro. As we go forward, of course, the US will raise rates in a couple of years' time. Into next year, the US will be outperforming Germany in terms of growth, and of course, we'll still have the Eurozone drama continuing over the medium term. This will all help to support the dollar and to lift it into the 130s against the euro into next year.
You mentioned there a certain amount of drama in the Eurozone. I mean, looking at the Franco-German rescue package for the euro, what did you make of that? And you still take the view that there's going to be a default in Greece?
What markets don't like, what they loathe more than anything else, is uncertainty. And what this package does is remove some of that uncertainty. With the default issue, they've included in the package is the provision for a haircut of about 20% on Greek government bonds. I'd call that more of a trim than a haircut. Actually, they need a much more severe buzz cut of a removal of debt, if you like, than what they're being offered. Perhaps 40 to 80% are numbers that are being put around. But it does prepare the markets, and it is forward-looking, which again is a departure from what we've had previously. There are some good things in this package, one of which is the more activist role that the EFSF is being allowed to do, so it can buy government bonds on the secondary market, it can recapitalise banks and so on. So this is a good thing. It's not big enough, unfortunately, to really ring-fence Spain and Italy. It's still being left at 440 billion euros. It will be increased in the end, I have no doubt about that. But again, it's a start. Will this package save Greece, solve Greece's problems? Well, no, it won't, of course, because what it doesn't do is deal with Greece's chronic inability to grow. Greece really does need deep structural reform in terms of its competitiveness, in terms of its governance issues, and this package, of course, doesn't do that. But what it does do is look forward for the first time and give Greece some breathing space, which has to be welcomed.
Turning to the third kind of trouble spot around the world, China. Do you think the Bank of China can engineer the desired soft landing for that economy?
Well, China has been a very risky country to bet against. It's outperformed the expectations of every single bear on the planet. If you look at it over the past couple of years, since 2008, it's grown by 9 to 10%. Fantastic performance given how much the rest of the world has struggled. So it's very dangerous to bet against China, I would say. However, what China's trying to do now is also very difficult. It's trying to ensure that growth continues, that remains perky. Don't forget, of course, in 2012 you've got the leadership transition, which is very, very important indeed, and not just for China but for the world, of course. So they're trying to keep growth going at a nice clip, while also trying to hold down inflation, while also trying to keep their currency control. So they're trying to sort of square all these circles. It's very, very difficult trick to pull off, I would argue. They've been trying to do it by raising bank reserve requirement ratios, by raising interest rates, all sorts of things, but inflation remains high. One of the risk areas to watch there, of course, is the housing market, and the housing market is very frothy. I think it's a bubble. Some people say it's overheating, some people say it's a bubble. I think it is a bubble. All bubbles do burst. However, when this one bursts, and I think it will, like they all do, of course, the issue here is not so much the bursting, but how the market recovers after that. And in the US, Spain and the UK, of course, consumers are very highly leveraged, whereas they're not in China. So the recovery could be different, although it would still be painful. So the issue here, of course, is with monetary policy. Can the Chinese government keep growth going, hold down inflation, get a soft landing for the housing market, do all those things at once and do them all gradually? And of course, with all that uncertainty, there's a big risk they'll overstep the mark and do too much and then bring the whole thing down rather harder than they would like.
Well, I mean, looking at that worst case scenario, if China does have a hard landing, of course, the big question is, what's the wider repercussions around the world for the rest of us?
Well, the repercussions are, of course, mixed like with any event. If you look at Asia, for example, Asia is very tightly linked into the Chinese growth story. South Korea, Japan, to name but two, their fortunes depend very, very heavily on what's going on within China. More broadly, if you look at commodities countries, for example, they've done very well out of the Chinese growth story over the past few years. Clearly, if you had a hard landing in China, by which we're talking about growth coming down to 7% or maybe a bit less, this would be bad news for them because commodity prices would come down. But it would also be good news, of course, for commodities users. So you'd see oil prices coming down a bit more, for example, industrial raw materials prices coming down and so on. So a mixed bag, but of course China has been very good news for the global economy over the past few years. So it's in everybody's interest that the Chinese authorities do manage to pull off this sort of slow, gradual slowdown and don't overstep the mark.
Well, thank you, Robert, for those insights, and thank you for watching. Join us again next month for the Global Forecast. Until then, thank you and goodbye.